Are we ready to go, Mary Beth?
Yeah, I was just getting ready to get started. Hi, everyone. This is Mary Beth. So glad to have you. I've got Jason and his partner on the line. I'm going to let them introduce themselves in a moment. But I've been working with them and been super impressed. My first experience with taxes, a while ago, many years. I took a 4 or 6 hour tax class, at the end of which I promptly went and hired a CPA. Taxes are not my strong suit, and it's been quite a conundrum trying to figure out how to work a direct sales business into tax requirements and what's legal and how to organize it. So I got to hear Jason speak twice at doTERRA's annual convention at some pre-business training last September. And I immediately put down his name and I started giving out referrals before I even had sent him my first email, because I was so impressed with what he had to say. One of the things I really appreciated about him is he is a platinum leader in doTERRA, which means he's doing really well. He runs a CPA business, and I believe he and his wife do some real estate and probably lots of other things as well. So they know their way around tax laws, and I have been super impressed, as has everyone that I've sent their way so far. And so I wanted to open it up not only to my immediate doTERRA team, but there's also some people on the call from Norwex, the greater doTERRA community, and a lot of people who either are new or maybe beginning to be established or fairly established in their doTERRA direct sales income. So I'm going to turn it over to them. And if you have questions, please use the chat bar. A lot of you submitted questions beforehand, which I've already sent in to Jason. I'm going to let them tell you about themselves, and I hope this is as helpful for you as it has been for me. Jason, I'm going to make you the host, so you're welcome to share your screen if you need to. And again, if you have questions, please use the chat bar.
Okay, great. Thank you for that introduction, Mary Beth. I appreciate that. So first of all, we're just going to introduce one another here. So James here has worked for, our company is called Waterfront CPA, because if my window weren't blocking our view, you could see some water out there. But we're a local accounting firm up here, but we serve clients throughout the nation. We've got clients in, I think, pretty much every single state. We have a very mobile community where we live here, and so that's kind of why we've specialized in working with business clients all throughout the United States. Prior to this, James worked for another small accounting firm as well. James is really good with QuickBooks. So if anyone's using QuickBooks and you need one-on-one training, James loves to work with small business owners one-on-one. He's really excellent at education. And I think it's because one of my little factoids about James is he used to be a math teacher. He taught high school math in a previous lifetime here, a previous career. So I think a lot of his teaching experience parlays over into what he does now. And then also another little fun factoid about James is he teaches salsa dancing. So,
yeah, so if you're ever over here, do a little bit of salsa.
Maybe we'll plan another Zoom call another time. Okay.
Thank you, Jason. And I'd like to talk a little bit about Jason Fila. Jason has a bachelor's and master's degree in accounting and federal income taxation. Jason and his wife own a small direct marketing business in doTERRA and are proud to have achieved platinum status. Jason works with dozens of MLM clients from various backgrounds and in various status. He enjoys helping them with every stage of their business development as they confront tax issues and plan for tax savings. Jason's clients often feel like his greatest strengths are his passion for tax planning, providing tools for their success and educational videos so that they can better learn how their businesses can take full advantage of the various tax deductions available to them. And an interesting factoid about Jason, he is proud of his wife, who recently put on lieutenant commander in the U.S. Navy.
Yes. So anytime I go home and I don't salute my wife, I have to give her 50 push-ups. So I'm a very in shape accountant, for an accountant, I should say. Okay, so we're going to jump right into some of these questions here, but just to kind of give you guys like an overview of kind of how I like to, how we like to approach things here. Whenever I'm talking to clients or anyone about taxes and any small business owner about taxes, I'm always coming at it from I'm trying to balance 4 different things here, all kind of at the same time. And some, they're not mutually exclusive by any means, but sometimes it does mean there's some balancing. And so the first thing I try to do is keep it as simple as possible, because I don't believe life is complex enough. I don't want to make life any more complicated than it has to be for anybody. So simplicity is definitely one of my main priorities. But sometimes we have to, get away from simplicity to get some of these other goals accomplished. And so the second one is tax savings. Any legal tax savings is kind of what I love to do, what we're passionate about. And also keeping out of trouble with the IRS. So just by the very nature of having a sole proprietorship, you are, and I'm not trying to scare anybody here, but you are 300 to 400% more likely to be audited than just the average taxpayer. Now, it's not a problem for you. I wouldn't say having a business. I'm not saying you shouldn't have a business. Having a business is a tremendous opportunity for tax savings. But you just want to be aware of where the red flags are. And this is why I tell pretty much everyone, I said, even if you don't work for me, with me personally, like if you've got a business, search out a CPA who's familiar with your business model and is going to help you stay out of trouble with the IRS, because we don't want to get audited, basically. So one of our goals is to try to prevent the audits as much as possible. And then, so the fourth goal is retirement. So I don't want to work with business owners and they're successful for 30 years and then all of a sudden they get to retirement and there's nothing saved there. So we've always got retirement planning kind of on the back of our heads, because it also turns out to be one of your greatest tax saving vehicles in a small business as well. So those are kind of the 4 different areas where we're approaching every situation from a tax situation. And we really like to do, like I said, tax planning. So we want to make sure we're thinking ahead, we're being as proactive as we possibly can. The first year, we're just trying to get up to speed usually. And then we're trying to be more and more proactive as we go. And then the second thing is we want to provide that education, which is why I'm grateful that Mary Beth provided this opportunity for us to talk about some of these questions you all have here. Now, some of these questions are very specific to your business, right? So it's like, even though there are some commonalities between your business and other businesses, direct marketing businesses, some of these are going to be like, I've got to get into your bookkeeping, and then we have to have a discussion about that in order for me to ask some of these or answer some of these questions. So I may not get to every single question specifically, and I apologize if I don't get to your question. But it just means that we felt like it probably required a more in-depth conversation about your specific tax situation. So I'm always trying to balance giving as much general advice as I possibly can to a group versus making sure that I'm taking into account everyone's specific situation. And I'm a very big believer that we really have to get down into the nuts and bolts, into the details, to make sure that whatever advice is you're given is really going to fit your circumstances. So that's, again, why I really recommend you work with a CPA, because at the end of the day, you want someone who's going to know your situation, everything you have going on, and is going to cater their advice to you. Because literally we could talk for days about all the different tax planning and all the different, bookkeeping and tax thoughts, and no one has time for that, frankly, and no one wants to sit through, hours of things that don't apply to them specifically. So we'd rather just see what you have going on and cater our advice to you specifically. But a lot of these questions really are excellent questions, and we can talk in generalities about some of these. So one of the questions here, just to get started, is it more advisable to file as a hobby when making very little money? And again, this is where I would say we would definitely want to take a look at what you have going on. It's hard to speak in generalities. But at the end of the day, whether or not you are a hobby versus a business, it depends on a kind of a multitude of factors. And there's like, some people have even enumerated 19 different factors or 3 overarching factors for whether or not you're a business or a hobby. In my experience, most people doing direct marketing consider themselves a business. And from my perspective, that's the most important thing. If you consider yourself a business, then it's a business. A lot of businesses start small. They start on the side, and you're working a job and you start it on the side. And so just because it's small on the side doesn't mean that it's not a business. So I wouldn't say that you are ineligible to take tax deductions against your income just because it's starting out small. I mean, at the end of the day, who doesn't start small, right? So in fact, I think a lot of the most successful businesses are starting, they start on the side, they start small, and then they grow from there. And they learn what they're doing, they kind of nail their procedures, and then they expand from there. So whether or not it's more advantageous to file as a business versus as a hobby, I would love to look at your exact situation. I could give you a really specific thought on that. But in general, I'd just say that for most people, you're better off filing as a business than a hobby, because as a hobby, you have to claim the income, but you get no deductions. So it's usually not advantageous to claim it as a hobby from a tax perspective. But if you're going, when you first start a business, you often have several years of losses. I mean, that's just the nature of starting any business, any small business. So at tax time, that's an advantage, frankly. So as long as we're taking into context the amount of the overall revenue versus the amount of expense you're trying to claim, we don't want to claim $10,000 of expenses against $1,000 of income, for instance, right? Because it's just going to draw some red flags. So we're always trying to look at exactly how things are turning out, and then we'll give more catered advice in a specific situation. And if I were to give a very simple answer to the first question, generally you're more advantaged to file as a business rather than as a hobby. So. Okay, so the second question, what are some MLM-specific tax situations or tax issues? So one was already brought up, am I claiming this as a hobby or am I claiming this as a business? And like I said, most people are claiming it as a business because it allows you to claim your business deductions. So if you're a builder, then I view you as a business personally. But technically, we could go through all these factors and try to have a more nuanced, discussion. At the end of the day, and I think one of the other future questions asks something about this: how many years in a row can you claim losses? So I will have some thoughts on that. But how about James kind of give some thoughts on what he says about that?
Sure. Yeah. So generally, if you have losses 3 years in a row, from the IRS perspective, you're considered a hobby. But they also look at.
So that's if you have more than 3 years, so you can have up to 3 years in a row, and you're a business from the IRS perspective. But anything above 3 years, sorry to jump in here, but anything more than 3 years, they have what they call a rebuttable presumption that you're a hobby. So if you go into your 4th year, and that 4th year you have a 4th year of losses, then technically the IRS is going to say, well, we think you're a hobby, but it doesn't. So it does increase the audit risk if you claim 4 or 5 years of losses in a row. Nevertheless, it doesn't mean that you can't do it. It just means that we have to be more strategic in how we do it. And we want to make sure we've got all of our ducks in a row. We really want to, at the 4th year of losses, we want to be looking at that business versus hobby question a lot more seriously, essentially, is what it gets down to. But go forward with that.
So in general, there is another requirement that says that 3 out of the past 5 prior years need to be profitable for the IRS to view your business as a business.
Yep, exactly. So to James's point there, if maybe we claim the first 3 years as losses, and then we claim a couple years where we really don't take all of our full business deductions. So we get a couple years of profit, and then we start claiming if there's losses still to be claimed, we claim additional losses. So there are strategies we can use to reduce your audit risk and make sure you're still getting, as much possible tax advantage as you can possibly get. Okay, so another MLM specific issue here. Oh, so a lot of you may have heard about S corporations, and the higher up you get into any business model, the more that you will hear of your upline talking about, oh, I'm an S corp. You should consider an S corp. And so I'm not going to dive all the way into what is an S corp super in depth, but suffice it to say that an S corporation is a separate type of entity. So it's not something you file on your individual tax return, but it's a way to get some payroll tax savings is what it comes down to. So if your business gets to be, let's say you're at 5 years into this and you're starting to pull in a real chunk of change, from my perspective, one issue that's specific to direct marketing is the ability to switch to become an S corporation happens sooner than it does for other businesses. And essentially it has to do with the fact that we have to assign a salary, and the salary is more flexible with a direct marketing company than it is for some guy who's opening a taco stand or opening a tire shop, or some of these other general kind of small businesses. I think we have more flexibility. So for instance, my wife and I, we're platinum, and we have an S corporation. So we switched our entity. We started out as a sole proprietorship, which I imagine most or all of you probably started out as sole proprietorships. And we may have a couple of you out there who are S corporations, have made that switch. And so that's what my wife and I did. And it made sense for us really early on owning our business. So what I would say is it makes sense to crunch the numbers for you to see if being an S corp would make sense. So that's one issue I think is specific to direct marketers. I mean, every small business owner is going to reach a point where they have to answer the question, should I remain a sole proprietorship or should I switch to an S corporation? And I'll tell you, after tax reform, the answer to that has gotten more complicated, unfortunately. So there were some really good things that came out of tax reform, but whether or not you should be an S corp, the waters have been muddied, basically. So for some people, it's become much more advantageous to become an S corp. Like they'll save an extra $5,000 a year by being an S corp. For other people who were S corps, now it's like less advantageous than it used to be. So essentially, what we have to do is, again, we have to just get in there, crunch the numbers, and I let the numbers tell the story, because I honestly, until we crunch the numbers, I have no idea what the answer is. It used to be that I could tell you really easily. I'd say, okay, how much is your business grossing? How much is it netting after expenses? And I could just tell you, yeah, you should be an S corp. Now I have to get in and really analyze those numbers a lot more in depth to be able to tell you if you should be an S corp.
So is there any kind of ballpark figure for an S corp or not really?
I used to tell people, yeah, 50,000, but there are CPAs that say 5,000. And so it partially depends on how aggressive you want to be. There are some, as much as we want everything in tax law to be like super black and white, unfortunately, there are some gray areas. And so it really depends on if you want to be more conservative in those areas or a little more aggressive. Now, I'm always trying to seek like a reasonable middle ground. I'm not trying to be super conservative in my tax positions nor super aggressive either. So I really wish I could give you a better answer, but it's just one of those things where it does depend on your specific situation. And I hate giving that answer, honestly, because it feels like such a cop-out. But I promise you, I'm not trying to do that. I really just that is the answer. So for some people, it could make sense pretty early on. What I will say for sure is if you're first starting out and you are running those losses the first 2 or 3 years, an S Corp definitely does not make sense for you. So hopefully, at least for some people, that answers it. Okay, so what other? Oh yeah, the big question always with direct marketing is, okay, well, hey, we've got all these, we're purchasing product, right? So we're put our money where our mouth is, basically, and we purchase the products that that we're selling, basically, right? So we believe in these products and we use them ourselves. And so the question is, what percentage of that is business, or how do I get my business deduction on that? How much do I deduct for personal purchases? And so again, this is another big question. And for some people, it's something like 95% of everything they purchase does go to their business. So it really is quite a bit. For other people, and I would say probably for most people, a more reasonable approach is that something between 10 to even maybe 60% of what they purchase is personal. Pardon me. And so I think it depends on the stage of business you're in. You know, usually earlier on in the business, I think it's more personal. As you get into your business more, it's more business. So I would say the higher your gross revenues, the higher the percentage of your product purchases we can expense. So I can say that kind of as a generality. But there are all kinds of methods for how you track those deductions, or how you track those expenses, how you will expense them. And partly it depends on, I have to figure out who am I talking to? Is this someone like who is very into the details and loves to track things and is a really organized person? Or is this someone who hates to do bookkeeping and hates to do that kind of thing? So to some degree, we're going to get pretty much the same answer, but how we get there depends on the person I'm talking to. But at the end of the day, we want to make sure we're backing out some for personal and we can't deduct that personal portion. So I have the full, we've got dozens of clients who are direct marketing clients. And I'll say we see the full gamut. We see some people who have, when we first start working with them, they've started out being super conservative and they don't deduct any of their product purchases, which I think is, that's kind of on one extreme. The other extreme is people who deduct every single thing that they purchase, which, what we want to do is try to move to a middle ground there, basically. So what we've done is, and I can get into this a little more later on, but essentially what I did is I created what I call a profit and loss tracker, or I just call it a P&L tracker, P for profit, L for loss, P&L. So profit and loss tracker. And I geared this specifically towards my direct marketing clients. It's what my wife and I use for ours as well. There are lots of different bookkeeping software that you can use out there. I don't recommend any specific, but again, I try to just make sure we keep it as simple as we possibly can keep it. And I created this P&L tracker so that you can make sure you're tying out all of your business income and business deductions in just one location. Because again, if you were ever audited, that's what the IRS would want to see. And so this is basically going to track every single deposit or every single withdrawal from your business bank account. And it's going to be able to take into account the fact that you might be paying via Venmo or PayPal or cash or whatever. It takes into account the various methods you might be paying or accepting payment. So with that said, the cleanest way to track your product purchases for Norwex or doTERRA or anything else you may be involved in would be one, you do personal purchases on a personal card, and you do business purchases on a business card. That's the cleanest way. I would say that's not the way most people do it though. But that would be like, if we had a gold standard, that would be it. Nevertheless, like I say, most people just use one card and they just put all their purchases on that one card. Some people who are super detail oriented, and this would be the next best method, they do all their purchases on that one card, but then they're tracking specifically, like, okay, I know this product and this date was purchased for business, and I used it in my business, and I used it as it's product testing, right? So it's a product that I normally wouldn't purchase for myself, except that I'm trying out a new product to see if I can talk to my downline about it, or see if I can sample people on it, or have it at a make and take or what have you. So any of those, but they're tracking specifically which items they've purchased. So that's kind of your next best method, is everything on one card, but you track specifically which items you're using in the business. It's pretty onerous to do it that way though, because you've got to keep really good records, and so you've got to be a pretty organized, detail-oriented person to use that. But that's a pretty acceptable method. And then the last method is you just have everything on one card, and then at the end of the year, we just want to make sure we're being reasonable and we're backing out some portion that's non-deductible personal use. And so this is kind of the least accurate method, but at the end of the day, I think it's still acceptable to the IRS in most situations, if they were to ever come audit us, because basically what we're showing is we're being reasonable. We're not trying to write every single thing off, in the kitchen sink for under our business, but we're showing like, hey, yeah, we acknowledge we use some of this for personal, so we're not going to write off that personal use, component. So, and then the other thing I'll say with the purchases that's kind of specific to direct marketing is it can be, you can have one really large category. Like sometimes we do a lot of purchases. So maybe we've got $5,000 of purchases in a year, or 10 or whatever. And we want to try to break that category up. So that's another thing this profit and loss, this P&L tracker does for people, is it helps them break up that large expense. If there's any one thing that gets people audited, it's having too large of an expense in any category, because essentially, so just to give you an example on this, there was a guy who wanted to write off. They bought an RV for like it was like $80,000, and they wanted to write it off into their business. And so they slapped some magnetic advertising things on the side of the RV, and they said, "Hey, we got ourselves a business expense, right?" Well, the IRS, and then they put it on their Schedule C, where they deduct, as a business deduction under vehicle expense. And so it was such a large expense relative to their income that they got audited. And so then that's when we met them, because then we came in to defend them in the audit. And so what the IRS does is, for every single line item on your tax return, for every single category, they assign what they call a DIF score, like stands for like differential. So they'll do statistical modeling on every single aspect of a tax return. And if the amount that you're reporting relative to other amounts on your tax return is outside the certain number of standard deviations, then your DIF score gets to be really high. And having a high DIF score doesn't guarantee you're going to be audited, but it means that your chances of being audited increase significantly. So at the end of the day, product purchases tends to be one of the higher expense categories. And so we try to break that up into its component parts. So product testing, right? What are things that I'm purchasing for my business that I'm using personally, but I wouldn't normally purchase if I didn't own a business, right? So it's like, I have to be aware of the products that doTERRA has to offer. And so I'm buying all these different oils that normally I might not buy, except for I want to be able to talk to people about them and say, yeah, I've used this, and this is when I've used it, and here's how I like it, and et cetera, et cetera. So you're using it personally, but you wouldn't have purchased it if you didn't have the business. So we call that product testing. And then we get that as a business deduction. Now, if you like fall in love with the product and you start purchasing it all the time, then that is no longer product testing, right? That's now personal use. So that's just, anyhow, those are some of the specific things that I feel like where there are some tax, direct marketing specific tax issues. So I'm sure there are others, but those are the ones that first kind of came to mind there. Okay, so.
You got a question there that says, what's the difference between S Corp and LLC?
Oh, that's a good question. That is a very good question. So here's where we're going to share our screen here.
Camila.
Okay, thanks for that. So let me share the screen here. So can you guys see our screen? Can you see the screen, Mary Beth?
Yeah, we're good. We can see.
Okay, great. All right. So essentially, every single business is going to have two jurisdictions you've got to be concerned about. And the first one is the state jurisdiction, and the second one is the federal. And anytime you have a business, you usually start out as a sole proprietorship, and then you look at switching to a different type of entity for maybe tax reasons or maybe legal liability reasons. And so again, you usually start with the sole proprietorship, and then you start thinking, well, gosh, maybe I should be an Inc. or an LLP or an LLC. Well, these different, whatever you choose at the state level has implications for what you are at the federal level, but it's not the same necessarily. So again, we're talking about two different taxing jurisdictions, two different sets of rules. So I think about this as like soccer, and this is basketball, like two different games, two sets of rules. You know, how you score a goal in each one is not the same. So, okay, an LLC is always formed at the state level. That's where you legally form your entity. So if you form your this LLC, then at the federal level, we have to choose how is that going to be taxed. Is it going to be taxed as a sole proprietorship, a C Corp, an S Corp? What you'll notice is there's nothing over here that says LLC. Like there's no tax regime set of rules just for LLCs. This LLC, I like LLCs personally because from a tax perspective, it's very flexible. We can choose any one of these entities at the federal level and designate this LLC as being taxed as a C Corp, or we could have it taxed as an S Corp. We could have it taxed as a partnership. Or let's say if you own this by yourself and there's no other owner of this LLC and you do nothing else, then you are what they call a disregarded entity filing as a sole proprietorship. So what that means is that you, for federal purposes, literally all they see is you. They don't even see an entity at all. So it just peers right down. It's as if you just had a sole proprietorship, and that's it. Or you could be a trust. So why don't you choose an Inc? Okay, if you choose an Inc, your only choices at the federal level are C Corp and S Corp. If you choose an LLP, you can only be a partnership. So at the end of the day, and if you choose a sole proprietorship, then all you can be at the federal level is a sole proprietorship. You can't be any of these other things. So to have the most flexibility of how you will be taxed for federal income tax purposes, having an LLC set up is really ideal, because then you could make that jump to an S Corp if you wanted to. Now, being an S Corp, again, it's a conversation worth having for most business owners at some point in their business structure discussion. Essentially, it's one of the very first things we talk about when we're meeting with new clients and we're determining what type of entity should you be. It's always in the back of our heads. It's kind of like tax planning fundamentals, the very first thing we're looking at, because it has some really strong implications for how you're going to be taxed. Because at the end of the day, you're going to be, the first set of taxes when you're getting taxed is going to be self-employment taxes, right, James? Why don't you talk a little bit about the taxes if you were a sole proprietorship, this is the first tax you're going to pay.
Yeah, so as a sole proprietorship, you're going to have to pay self-employment tax. You're going to have to pay the employee and employer portion of both Social Security and Medicare. So that's going to be a 15.3% tax on your tax return. And that's in addition to the income tax.
Yeah, so essentially, the reason people consider doing an S corporation is because essentially it's almost like being triple taxed. If all you were doing is getting a W-2, all you would pay is this portion of a payroll tax, right? So when we say self-employment tax, when we say payroll tax, it's all synonymous. It means the exact same thing. We're talking about Social Security and Medicare. And so it's 6.2% for Social Security tax and 1.45 for Medicare tax. And that's if you're just an employee. If you own your own business, all of a sudden, boom, you're paying the employee portion and the employer portion. So that's like being twice taxed right there. And then as Jane pointed out, then you pay income tax. So it can really add up pretty heavily. Tax reform did some things, did one major thing to kind of reduce this heavy tax burden. But essentially, the reason you would switch to an S corporation from being a sole proprietorship is because you want to reduce your payroll taxes, these self-employment taxes. And so, again, I'm not going to go into crunching these numbers for you guys as a group, because it's really a conversation that you've got to have with your CPA to see if it's the correct thing for you to do. So there are pros and cons to being an S corp. There are pros and cons to having an LLC. So in a lot of states, by the way, you say to yourself, well, why don't I just choose an LLC and at least I'll get some legal liability protection? Well, we're CPAs. I'm not an attorney. James is not an attorney. And so we can't speak to the legal liability protection aspect of what it means to own an LLC. But what we can say is that, it does give you a lot more flexibility at the federal filing level to choose a different type of entity. There's some degree of legal liability protections by having an LLC. I wish I could even just tell you all, hey, if you have a business, you should get an LLC, because then you get some more liability protections. Unfortunately, I can't say that, because some states, it's so easy to form an LLC. It's so easy to maintain an LLC. It's a very low cost. It makes a lot of sense. And I would say probably for most states, that's the truth. So any business endeavor my wife and I embark upon, we choose an LLC and we go that route. But there are some states where it's onerous to form an LLC. It's costly to start. It's costly to maintain. And your high tax jurisdiction states are, kind of the obvious states that come to mind here. We're talking about, California, $800 per year just to have an LLC. So for most of us, it probably makes sense to consider having an LLC. Do we all need it? Is it worth it for all of us? Probably not for everybody. But it's worth having that discussion with your CPA to see if it makes sense to get that formed. But hopefully now you can see you could have an LLC and it could be filing as an S corporation. You could have an LLC and it could be filing as a sole proprietorship. So if someone comes to me and says, "Hey, Jason, I have a business," and I say, "Okay, what kind of entity are you for federal purposes?" And they say, "I'm an LLC," and I'm saying, that doesn't mean anything to me, because you could be anything. I have no idea what you are. So we really have to look deeper and to see exactly what you are. To have your LLC become an S corp, you have to affirmatively elect. It's something you've got to actually go out and do. And you've got to file paperwork to do that. And I would always recommend that you work with the CPA, definitely, to do that.
And that S corp election is supposed to take place within the first 2.5 months of the year.
Sonia, hopefully that answers that question without beating a dead horse to death. again. Okay, so let's see, where did that, oh, I'm gonna stop sharing so we can see other questions. Okay, so yes, LLC means limited liability company. So yeah, so the C and the S, it's all about, someone asked if there's this, what does the C and the S mean? So by the way, I'll just tell you right now, the two entities you should choose between almost always is going to be a sole proprietorship or an S corporation. Usually for most business owners, that's really what it comes down to. And I would say, especially for direct marketing companies like us, I think it totally makes the most sense to narrow your choices down to those two types of entities. A C corporation, I'm not going into depth into that, but essentially you will pay always at least 36% tax on whatever you make from the C corporation. So I don't really talk about that in depth here. I don't want to go into depth in things that I know aren't going to pertain to you guys. So we'll skip talking about the C corporation and the partnership and, for now.
So it looks like Carol Ann had a question. Please explain how an S Corp saves money. Without going into depth, for an S Corp, you can take part of your earnings and you don't have to pay tax on it because, well, you don't have to pay self-employment tax. You can take part of your earnings as distributions, shareholder distributions. So you're only going to be paying that self-employment tax on part of your earnings, not your entire earnings for an S Corp.
Yep. So if you were, as a sole proprietorship, you pay on the very first dollar of your net income. So you're right here. If you made 100,000, I mean, let's just put this down to like 20,000. This is 15,000 in deductions. If you were a sole proprietorship, you will pay. So if you gross 20,000, you have 20,000 or 15,000 of business expenses. Your net income, meaning after expenses, is 5,000. Then you will start paying this 15% tax on every single one of those dollars. Whereas if you were an S Corp, you don't, to James's point, you're not going to pay self-employment taxes on every single one of those dollars. You'll pay income tax on every single one of these dollars, but not self-employment tax on every single one of those dollars. So, but again, it's if you're really thinking about doing an S corporation, I would recommend you meet up and chat with a CPA about that. And by the way, one of the things, like we said kind of in our intro, we really believe a lot in education and trying to make sure it's catered specifically to our clients. So that's why we like to meet one-on-one and give very specified feedback based on what you have going on. So, but one of the things that we'll do is we create some of these videos where we'll post them privately onto YouTube, and then we'll send out the links to give some education and training. So if someone asks some of these questions, like how much of our travel expense can I deduct? Should I use the mileage method or the actual method to deduct my business vehicle? How do I track my mileage? How do I do my bookkeeping for my business? Like all of these questions we have created trainings for. And so for a lot of our clients, for all of our clients, when they have these questions, we'll send this video to them so they can always reference it. They get a very good understanding of what's going on, and then we can have another follow-up conversation where we answer any additional questions they may have on it. So like I said before, we really love to focus on education. Okay. So, and you have to, right now, or I'll just tell you right now, we're like 6 days away from our filing deadline. So we're kind of operating off of very little sleep right now. So I would say our videos are usually better than what we're presenting right now, but we're operating under not our optimal normal circumstances. This is not when we usually do our videos. But we are very happy to be part of this. So I really am grateful to Mary Beth for that. But just kind of take what training we're doing right now with a grain of salt in terms of how well we're doing. Usually we'll have more exciting stories to share and whatnot in our video trainings.
You're doing great.
Thank you. Okay, let's see. That's another question here. Okay, James, why don't you talk about that? You mentioned that question there.
Okay, question, are reusable supplies used for events a straight business expense, or do they need to be depreciated? So most of your supplies, as long as they're business oriented, then they can be expensed. And that applies to anything under $2,500. So if it's over $2,500, a particular asset or supply, then you need to depreciate it over a period of years. But most of your supplies you can just straight expense.
Yeah, and just to piggyback on top of that, what James is talking about there. So let's say you've got to, you go to shows, you set up booths, and you take your own tables, right? And you purchase your tables, and you purchase your chairs that you take everywhere with you when you do these booths. So if all of that, if each item costs $2,500 or less, then we just put it on the profit and loss and we expense it. Now, there actually may be times when you're actually more advantaged to not do it that way. Maybe sometimes you want to put it on your depreciation schedule, and we, in accounting lingo, we call it capitalize it, where you're not going to deduct it this year, but you're going to spread it out over the next 5 years. And you think, well, what's going on? Oh, that's like counterintuitive. Why would you do that, Jason? Because maybe we want to push some of your deductions into the future, because if your business is expanding rapidly, now sometimes you take a while. Some people take longer for their businesses to grow. They have more of a slow growth approach, which is totally an acceptable way to grow. Others have they're growing rapidly, and so if you have a rapid